All right, so let's move on to the rest of these 7 stocks. So we still have Netflix to talk about, Shopify, Tesla, and Booking. So I'm just going to go ahead and do all of these. At the same time, I have gone through the process on the last 3 videos, and so, I don't want to hammer it to death, but I do want to talk about each one individually. So as far as Netflix is concerned, why Netflix? Well, Netflix, number one, is an expensive stock. It's also an empire, and it has been the leader as far as streaming services are concerned, and it works really well with this strategy. The most important part, I feel, is that it has really high premium in the strikes, and because of that, you're able to sell out of the money premium and it still has something in it. So I'm going to actually go over to my tools here. It's kind of hard not doing a live class on this, but anyhow. So Netflix is an interesting case because Netflix just had earnings and it had this big gap down, and this is actually an ideal time to use this strategy. So if you can actually notice when stuff like this happens in the market, and focus on, if you can actually notice when stuff like this happens in the market, and if you can come in and say, oh my gosh, this is a great time to use the 5-star strategy or the 7 stocks to success strategy, you're going to do even better because it makes it a lot easier if you come in and you sell out of the money premium right at a support area. So, you can do it on the calendar, but I guarantee you will be in a better spot if you wait for these dips. And for example, right here, you have a ready aim fire buy, you've got a volume buy, you're at a 1618 extension. So for all of those reasons, it looks like a good time. Now, you also have the situation where you have this giant gap down after an earnings report. This is about a 2x move. And so you look at it and you say, okay, well, which direction should I do? Well, first of all, Netflix has been range bound throughout a large portion of 2019. And so for that reason, I do think that it's a good candidate for out of the money, both on each side. And in this particular situation, I was actually trying to trade it back up to here, which is about 336. So let's see what the spreadsheet says. So let's go into our handy dandy options chain right here, and we're going to go down to next week. Now, today is Wednesday as I'm making this video, but I'm still going to use next week's series. We could also go out one more week and see what happens. But let's go ahead and pull up our spreadsheet. Where is it? Come on. There we go. All right, so spreadsheet. Here we go. Okay. Oh, it's not going to work. For some reason, it doesn't want to be on the same screen. All right, so I'm going to pull up Netflix on my other monitor so that I can actually do this because it doesn't want to cooperate with my whole screen sharing, but that's okay. So Netflix is trading at 317. So we're going to change this to Netflix, and I probably need to make this bigger, don't I? There we go. So 317.94. And then we need to check the implied volatility, which is going to be 31.91%. And then the expiration date is going to be August 2nd. 08/02/2019, which would give you about, let's see, market's closed. 1, 2, 3, 4, 5, 6, 7 days. All right, so now we have our bounds. So looking at the bounds, we always want to take a screenshot of this because we want to know what it looked like when we were getting into the trade to begin with. So there we go. Now we have our screenshot. Okay, great. So what are we going to do? Well, you want to go back and you want to compare that against what your actual chart looks like. So you can see the bounds at 331. And remember how I said I was going to try to trade it up into 340, but I wasn't sure that it could make it. Also, I would not expect it to make it in 1 week. So I think that selling call credit spread at 331, I think that's a good plan. Selling a put credit spread at 303, I think is even better just because of the way that the stock is recovering off of the lows. And these, of course, are even higher probability, but they're going to be a smaller credit. So I'm going to move this over to a different monitor so that I can look through my trades. Now, because it is Wednesday, there's probably not enough premium in here. So I'll see if there is, but if not, we can go out one more week. So looking at 331, there's actually still pretty good. You see how there's $2 left in this? It's going to go to sell, vertical. 40 cents for $2.50 wide, that's not bad at all. So looking at a nine day, you're looking at kind of a 9-day range right here, and you have $2.50 wide for 40 cents. That makes sense. Now let's try it a little bit out further at 340, because I think this one was better. I think this one's higher probability. But you're going to get about half of the credit. So you're only getting a 15-cent credit there. So it just kind of depends what kind of size account you have. I would just do the 1 standard deviation. And then on the put side, you have 303. So let's do 305 just because it's a nice round number. So 305, 302, do you see how that credit is almost the same? And I actually do favor the put side on this just because remember how I told you that you have to look at the lows, the highs and the lows? So you see how the low was at 306? Well, if you sold a 305 put, you're selling the puts right at the lows. And so that's going to be the low of the 5 and the 10-day range, which is making it a higher probability. So I actually like that quite a bit. I don't know that I would like the 5-star strategy in this particular instance just because Netflix did just kind of roll over and die. If it had a squeeze or something like that, I think I would like it a little bit better. So I think I'm going to avoid doing a 1-to-1 risk reward. I think because of the drop that this experienced, I would rather just do the 1 standard deviation or even a half standard deviation, because if you did it at your standard deviation is $14, and so if you did it right around in here, I think that would make a whole lot of sense. So if you did it instead at, just remember, let's just flash back to this. So your standard deviation is $14. So instead of selling the 303, if you sold the 310 as it's heading higher, I mean, that makes a lot of sense to me as well. So I like that. Now let's go ahead and move on to Shopify. So remember, just because of the sheer timing of when I'm recording this class, there's earnings coming up. You do not want to hold these strategies through earnings. That is not what you want to do at all. August 1st is the earnings date, but I'm still going to show you how to do it just because, like I said, I'm explaining this when I'm doing the class, but you don't want to hold any of these strategies through earnings because the stock is likely to have a greater than expected move. So looking at this here, this is a beautiful, beautiful, beautiful trending pattern. This is one of the 5-star patterns. I absolutely love the 5-star on this one. Okay, what does that mean? Every single pullback to the 21 or the 34, that's when you want to time your entries and you want to sell the 1-to-1 risk reward put credit spread. How do you get 1-to-1? You sell it at the money. So looking at this right here, you have earnings on the 8/1 and you have a stock price of $329.57. So let's change it to shop. And then let's check let's see, we have 70% implied volatility. Now remember, that's because it's in an earnings week. So it would normally be a little bit lower. So let's fill it out. 70%, 7 days. Okay, here's your range. So on this, because it's a 5-star ticker, what does that mean? It has a beautiful, beautiful, beautiful trend. And by the way, at the end of this class, I have a section just on the 5-star trade. So what that means is that I would not sell a call credit spread on this one. I would sell the puts, sell the puts, sell the puts, okay? And I would even do 1-to-1 risk reward just because it's so clean. So looking at the levels that you can do that, 297, 281, or 265. So let's price it out. 297. Okay, so remember it's also better to do the half strike just because there's more volume. So let's do 300. All right, 50 cents. That's pretty good for a $2 wide spread. Okay, looks good. I like it. I like it a lot. So the other thing that I mentioned is, you know, looking at the pullback to the 21. If, for example, if we're not right now, we're right on the 8, but if we were back at the 21, what you would do for a 5-star trade, pretend we're at the 21. All you do is you look at the 1-to-1 risk reward, which is going to be right at the money. Where when you're at the money, it's right where the blue meets the black. So for example, if you sold 330, 320, 750, you see how you have a 1-to-1 risk reward now? That is a 5-star trade. So you can do that 1 standard deviation, you can do the half standard deviation, or you can say, you know, I have a lot of confidence in the direction of this chart, and I'm actually just going to do a 1-to-1 risk reward on the trade. I'm going to make it $5 wide, and I actually think that this risk reward is better, and I like the overall pattern. So that all makes sense. Let's go to the next one. So we have Tesla. So Tesla is hard for me to do today just because it has earnings today after the close. But it's the same idea. You have to look at what the trend is doing at the, you know, you want to watch for when it crosses over the 50-period simple and when the trend strength candles shift from red to green, and that's when you shift your direction. So during this entire direction down here, it was a little sloppy in here. That's iron condor time. All throughout here, this is call credit spreads, call credit spread, call credit spread, call credit spread, call credit spread. And then you're going to have a time where you see the trend strength candles start to tell you there's a warning. They go from red to yellow to green. Oh, sorry, don't be selling call credit spreads anymore. Something's changing. Then you get the confirmation of the moving averages and the price closes up above the EMAs right here. This is the point where you start selling puts, okay? So I don't really want to go through the whole thing on Tesla just because it's the earnings report is today and it's going to change everything. But, you know, I've gone through this, how to use the spreadsheet. The most important part is looking at the trend, and we're going to have to do that one after the earnings report is over. So let's just wait and see because Tesla earnings can be a little bit crazy. And then the last one is booking. So for me, for this one, Iron Condors has been the best on this because of the overall structure of the chart, because of the way that it's traded up, down, sideways, all that stuff. It's just very sloppy, very messy, and it doesn't really have a discernible trend. It also has a very high stock price. So 1919 is your stock price. And if you look at your implied volatility, it's going to be about 18%. And it gives you a very wide range when you plug this into your calculator. So by checking out the calculator, you can see that you're able to sell on both sides. And the coolest part about this one, I think, is because you have the bounds right here to do your Iron Condor, you can just go ahead and price that out. So looking at an Iron Condor, I would even give it 16 days just because the stock is such a large stock. But what you want to do is you can right click anywhere. So Iron Condor, and then you need to use your spreadsheet to write your strikes in. I would do the 1 standard deviation. So if you sell the calls at the 1 standard deviation, that's going to be 1966. Well, obviously that's not an even number, so let's use 1965. And then we'll do 1970. Then on the downside, we have 1871. So let's do 1870. Then we do it $5 wide. 1865. So, I mean, honestly, this is the best one that I've seen as far as risk to reward. You have a $4 credit in a $5 wide spread. So that is, I mean, that's an excellent risk to reward. So honestly, out of all of them, Booking, or what used to be Priceline, is a pretty volatile stock, but because of the 1 standard deviation and the amount of premium that it has, because of the overall choppy nature of it, you're really still able to sell premium. Now, if you want even further out of the money, 1.5, 2 standard deviations, you can do that too. I personally would not do the 5-star strategy on this chart at all because it's not a trending chart. The 5-star strategy is a trending chart. So that is the last of those. There are a couple others. For example, like O'Reilly. This is also another high price stock. Some of these other high price stocks that you can do this on, you just have to keep in mind that a lot of them aren't going to have weekly options. You can still do it on a monthly basis instead of a weekly. The reason why I didn't include something like O'Reilly is because it doesn't have the weekly options, but you could also do it on Adobe as well. So Adobe is one of my favorite 5-star stocks. It's one of my favorite Phoenix stocks. And, you know, I picked 7 in this class, but Adobe's another great one to use this strategy on. So you can consider stuff like O'Reilly, consider stuff like Adobe. It's not only those 7, but also the fact of the matter is if you focus on just those, you know, if you focus on the same stocks over and over again, what happens is that you get really good at it. And so maybe some of these stocks, you won't like them, you don't like to trade them. That's fine. You know, you just need to figure out what you are good at and what you like. And you need to get into kind of a flow with it. And from there, that is where you're really going to succeed and where you're going to be able to make money. So make sure you stick around. Make sure you stick around for the next couple chapters. I know that this was kind of the meat of which stock is it and how do you do it, but the following chapters are very, very important about premium selling. Why do we sell premium? Let's sell iron condors. Let's sell credit spreads. And then also your risk control is absolutely critical. So make sure you check those out, and I'll see you in the next chapter.